All I'm trying to do is set the stage for where we are at this moment. Look no further than Nvidia today to see how algorithms and high-frequency traders are taking over the tape. The market is retreating. Nvidia is down because of the enormous volume of zero-dated options it is seeing. Alright, so if high valuation was your main fear about a portion of the market's mega cap a month ago, then Nvidia's forward PE was 41 times a month ago. Today, it is 32.5. Meta was at 24.5 times a month ago. It is now at 21.5 times. Today, Apple is 29 years old. Amazon used to be 38, now it is 31. Alphabet used to be 23.5, now it is 19.5. Microsoft is now 30 years old. I suppose what I'm trying to say is that these stocks have significantly declined. Jimmy, if the valuations were previously irrational, are they now more reasonable? Today, Barclays improves its technology. They switched to overweight after a significant 16% decline since July. Rob Sin announced yesterday that he has finally, yes, for the first time, purchased Nvidia due to the stock's steep decline. In light of this value correction, what should I do? Yes, as I believe we should appropriately refer to it. Though I didn't hear everything he said yesterday, I believe Rob Sin, who is buying, is a great example here. He said, look, of course, it can go lower from here. But if you look past the next month, and this is what I was saying a second ago, and you look to the end of the year, these valuations and these share prices are likely to be higher. We cannot just examine multiples in a vacuum, and there is a very straightforward explanation for this. The multiples must be compared to the growth rate of earnings per share. I see you nodding your head as a growth investor, Carrie. You get exactly where I'm coming from. When determining if a stock is overpriced, the price-to-earnings to growth ratio, or PEG ratio, is important. Nvidia, perhaps the most talked about stock, has a PEG ratio below 1. It has a 32 times multiple going forward and is increasing its earnings per share in the mid-30s. That is a very alluring valuation for anyone familiar with PEG ratios. I'm aware that it can drop, but I believe that from now until the end of the year, it will reach a new all-time high. But are there any indications that things are moving too far in the opposite direction? For instance, Micron is planning to start its buyback again today. We can display the Micron chart. Are they acting in this way because the stock has dropped by almost 30% in the past month? Does it look better now? Was it overcorrected? You should decide that, not me, but it still begs the question. Adam Parker, who was with me yesterday on * closing bell * and is, incidentally, a former chip analyst at Bernstein, before moving on to other roles on the street, remarked, well, there's been a lot of destruction. I want you to hear his thoughts on whether the semiconductor industry is currently appealing. Over the past 25 years, I examined the 10 most recent downturns of 10% or more. I looked at which industries and how equities often decline, and I thought, well, what has happened in this last cycle since July 16? I sorted by the largest difference, and the semis are down. In comparison to everything else, the semi-cap equipment is down more than usual. All right, I'll go to you, Joe. Are they attractive purchases? Once more, Adam is generally right. If we're analyzing valuation and looking for semis with lower valuations, I look at the names of the semis. Take a look at the equipment names: Applied Materials, Lam Research, and KLA Corp. Despite having good fundamentals, they have all worked off enormous excessive and extreme bullishness, if I may use that term. What else do they possess? They have buyback authorizations, and we're approaching a time when we'll reopen that buyback window, as you said. It obviously provides some support in unique situations for stocks that you find interesting. But I'm not claiming it will be the last spark that propels notable appreciation. This is crucial, so let me add a few more words right away. Earlier, I discussed the PEG ratio and the growth rate of earnings per share. What happens if the growth rate is incorrect? Looking at the capital expenditure plans of companies like Google and Meta gives you a lot of reassurance that the growth rates are correct, in my opinion. Whether it's Nvidia chips or Micron's high-bandwidth memory chips, they need processors to expand their AI efforts, and they have the financial resources to do so. They have the cash flow to do it, but they're planning for years ahead of time, rather than taking on more debt or anything else that might be impacted by market volatility. Therefore, those growth rates are supported by the fundamentals. When it comes, that's one way I would look at it, and we have been looking at it. If you look at the charts of some of these, like ASML and Broadcom, for example, both of them are currently resting on a significant moving average, the 100-day for Broadcom and the 200-day for ASML. I believe that if you keep an eye on these stocks over the next few days and nibble at them if you don't already own them, you may purchase more if they establish levels of support. Micron is still in a straight-down dive, and you don't know where it's going to hold. Additionally, I believe that it is accurate to say that if you tally up the capital expenditures that you assume the major corporations, such as Google, Apple, and Amazon, are making on chips, you will easily find $200 billion from all of the big cap names, and that money must go to someone. Therefore, the chip manufacturers, mostly Nvidia, but not exclusively, come first, followed by the equipment manufacturers. Well, you're still optimistic about the market as a whole following a week in which we receive guidance from ARM, Western Digital, Intel, and Microchip. No, my bullishness is more limited to corporations that support Nvidia or truly invest in the GPU. Look, on the Amazon conference call, they stated that Nvidia is sold out, demonstrating their complete awareness that they must invest in AI. For a very long time, possibly until 2025, they are sold out. Indeed, it hasn't deterred anyone from believing that Nvidia will continue to be the main benefit despite the expenditure plans that we've heard and been confirmed by companies like Microsoft, Meta, Alphabet, and Amazon. However, the market is currently undergoing a significant shift. Consumers are ultimately worried about whether the Fed is falling behind, but none of it seems to address the core issue, which is that Nvidia may be sold out for some time to come. Indeed, Amazon must undoubtedly construct its own, but that is a defensive tactic because they are unable to get enough. Regarding Amazon's approach, their significant upfront expenditures, such as buying aircraft and constructing AI-related infrastructure, should be viewed as a longer-term investment in steady demand growth as opposed to short-term profits. These actions demonstrate Amazon's strategy for maintaining its competitiveness in the AI-driven cloud market as they seek to acquire the expertise and resources necessary to fuel future expansion. This is one of the reasons they aren't hesitating to make the large investments, even though the rewards won't be completely felt for some time. Another factor to keep an eye on is the DOJ's investigation into Nvidia's market dynamics, since competition may be impacted by regulatory attention. Nvidia's supply limitations, which are probably going to last until 2025, indicate that demand is always outpacing available capacity. This reaffirms how strategically significant Nvidia is to the semiconductor and AI industry. Rising interest rates and inflation pressures are two examples of factors that complicate consumer behavior and macroeconomic issues. However, since the sector continues to place a high priority on long-term growth, the underlying need for cloud and AI infrastructure may remain resistant to these concerns. Therefore, even while there is undoubtedly some risk in the tech industry, especially if prices overcorrected, the recalibration of these important names may indicate a more optimistic future. From a broad standpoint, this may be viewed as a turning point where long-term benefits could be obtained from strategic investments, especially in semiconductor and AI-driven businesses. Additionally, keep in mind that the first 50 clients can still receive a 50% discount on anything in our store for a short period of time. Shop today using the link below to be among the first 50 people to take advantage of this limited time promotion.